Good morning, class. This week, we will be discussing the financial plan. Specifically, we will be discussing the role of budgets. We will be discussing why positive profits can still result in negative cash flow. We will be looking at how to prepare pro forma cash flow, income, balance sheet, and the sources and applications of funds statements for the first year of operation. We will be talking about the break-even point. And lastly, we will be discussing some software packages that can help you. To begin with, let's talk about the financial plan. Why would we want to include a financial plan within the business plan? To put it simply, when the investors or the bank or the reader of the business plan looks at this section, it will allow them to understand how funds enter the organization, also when they enter, how those funds are spent, and what is the available cash. Lastly, it will allow the reader to know the projected financial future of the firm, at least for the near term. In essence, the financial plan explains how the entrepreneur is planning to meet its obligations and maintain its liquidity. In general, the financial plan will need 3 years of projected financial data for outside investors. So let's talk about budgeting. Why is budgeting important? It makes you think about how you will take your strategy into implementation. It provides financial discipline because it makes you think about resource management. By creating and following a budget, you can navigate the early stages of your startup journey, and it will be easier for you to do that if you have a plan. The benefits of budgeting are manifold. For instance, it helps you with resource allocation, as we've already mentioned. Since entrepreneurs typically have limited resources, a budget is helpful to allocate their resources efficiently and effectively. Planning, financial planning, budgeting is very useful to anticipate your financial needs, including expenses, revenue projections, and this allows you to know what you need. And once you know what you need, then you can secure fundings or loans. It also helps with communication because a budget provides a framework for controlling your finances. It sets spending limits and helps you avoid overspending. So if you are working with other people in your organization, you have to negotiate to know how much needs to be spent and if you can get resources from a different area of your company. It also helps you with goal setting and measurement. A budget helps you set specific goals for your organization. The goals could be related to revenue targets, profitability, or expense reduction. As you progress, you can compare your actual performance against the budgeted numbers to make sure you are reaching your goals. And this, in turn, helps with motivation because those goals are going to be tied to people in your organization. So if you have salespeople, for example, you are going to allocate them goals to reach. And that is going to give them motivation to compete and to ultimately reach those goals. And as you can see, these are all related and it goes in a circle. Why? Because a budget is not a static document. As you operate your startup and you gather more data, you can learn from this process. You can adapt, you can refine your budget based on actual results, and then you can make more informed decisions in the future. Before developing the pro forma income statement, you will need to prepare operating and capital budgets. If you are a sole proprietor, you will be responsible for all budgeting decisions. In a partnership, you may need to negotiate and ensure that everyone is on the same page. In the preparation of the pro forma income statement, the entrepreneur must prepare first a sales budget, and we'll talk about the sales budget more in a minute. But the sales budget is based on projected sales, and there are several approaches that you can use to forecast sales. From the forecasts, you will determine the cost of the sales. Also, you'll need to think about inventory because demand can fluctuate, so you need to be prepared for that. So your sales budget serves as a basis for your decisions on inventory, but just make sure that you have a cushion to allow for higher demand. You'll need a production or manufacturing budget. This budget provides a basis for projecting cash flows for the costs of goods produced based on the units of inventory. The important information from this budget is the actual production required each month. Operating budgets. You need to think about operating costs. So for this, you'll need to list fixed expenses that occur regardless of your sales volume. For example, rent, utilities, salaries, advertising, depreciation, and insurance. You'll also need to calculate variable expenses that vary month to month depending on sales activity or changes in marketing strategy. And this budget, along with the manufacturing budget, is the basis for the pro forma statements. Now, capital budgets are used for evaluating expenditures that will impact the business for more than a year. A capital budget may project expenditures for new equipment, vehicles, computers, new facilities, that type of thing. Those decisions may include evaluating the cost to make or buy decisions in manufacturing or a comparison of leasing. So is it better to build a new plant or can we just lease the space? Do we need to buy the equipment or can we just lease it? If you have a large project, then of course it's advisable to enlist the help of an accountant. Here's an example of a manufacturing budget. Like I said, the manufacturing budget is important because it will allow you to know the needs for cash flow based on the number of units you need to produce. So as you can see, for instance, in January, you have projected sales units and you also have a desired ending inventory. You don't have a beginning inventory because that's the first month that you're manufacturing. And as you can see, the following months, the units of the total production of units required increases, but it also takes into account the beginning inventory. In this example of an operating budget, you can see that you have fixed expenses as well as variable expenses. For instance, your rent is fixed at $2,000 as well as your utilities at $900. But then you can see the variable expenses. For example, advertising. And so you have to think about your sales cycle, you have to think about your marketing plan and see when am I advertising so that my advertising costs may increase. That way you can create a monthly operating budget that takes into account not just what's happening in your company, but also the sales cycle and the macro environment. Here's an example of a capital budget for a company. They are purchasing a new equipment. There's a reason why they're purchasing it. The cost is $300,000. Look at the financing. The financing is based on equity. So the founders are putting $100,000 from their own money, and they are borrowing $200,000 from a bank at an interest. This bit is important because an investor, if they look at your capital budgets, they will take a look and see if you are invested. So they like to see this type of thing. Also, in a capital budget, you would list the expected benefits. Why am I purchasing this? In this particular case, they are reducing the operating costs by 20% and they're expecting a revenue increase. They also include how much it's going to take them to pay. And finally, the return on investment as well as the risks. This is a very simplified capital budget, but it gives you an idea of the things that you need to pay attention to when you are working on a capital budget. We talked about forecasting sales. How does one forecast sales? This is an interesting topic and it is close to my heart because this was one of the first positions I held. I worked for Sprint. Back then it was called Sprint PCS. And I was in charge of forecasting sales at the beginning of the company when they first opened. In the case of Sprint, for example, depending on how much forecast we projected for every month, that in turn determined how many people we needed in customer care, determined how many units of phones we needed, and it determined the sales goals for the salespeople, so for every store. And so there are several ways that you can do forecasting of sales. So for historical data analysis, you would start by analyzing historical sales data if you have it available. You would look at past sales figures, seasonality patterns, and any trends or fluctuations. Of course, this is the best way of predicting future sales. But if you don't have historical data, then you can conduct market research. That way you can understand your audience, you can understand your competition and your industry trends. You would need to gather information on market size, customer preferences, and then changes in demand. Sales funnel analysis. You would need to analyze your sales funnel. So this involves tracking the conversion rates of leads to customers at each stage of the sales process. It helps to estimate how many leads are needed to achieve your sales goals. You can use assumptions. You can make assumptions about factors that could impact sales. For example, changes in marketing strategies, economic conditions, new product launches, or new competitors entering the market. So based on the data or your assumptions, you would project future sales. And the projection of sales could be done in a top-down approach. So you will start with a market size estimate and then calculate your market share and then your sales based on that. You can do a bottom-up approach where you can estimate sales by breaking down projections for individual products, for territories, for customer segments, and then you can aggregate those. You can also use qualitative methods. So you use expert opinions, customer feedback. You can use surveys to make sales predictions. Your sales forecasts will need to be revised. So it's not an exercise where you do it once and you leave it alone. You have to look at it continuously. So as new data becomes available and circumstances change, you need to make changes on sales. And sales are the major source of revenue since other activities relate to sales. And so it's usually the first item that must be defined. In preparing the pro forma income statement, you need to calculate sales by month. And you need to be realistic because it takes a while for any new venture to build up sales. And at the beginning, the cost of achieving the increase in sales might be higher. Sales revenues for an internet startup, for example, are often more difficult to project because you'll need to work on extensive advertising. You might have little sales revenue, and you can also use other data for example, number of hits. It's possible to project the number of consumers who will buy products from the number of hits or number of visits to your internet site. The pro forma income statement also provides projections for operating expenses for each month of the first year. Selling expenses as a percentage of sales may also be higher at the beginning. The cost of goods sold can either be directly computing the cost of producing a unit times the number of units sold, or you can use an industry standard percentage of sales. Salaries and wages reflect the number of personnel employed and their roles. So you need to include hiring and salary costs for new positions. Also remember to include any anticipated raises. The entrepreneur should also consider increasing selling expenses as sales increase. In addition to the monthly pro forma income statement for the first year, projections should be made for years 2 and 3. And here's one for the first year, but investors generally prefer to see 3 years of income projections. Okay, so the very first year, month by month, and then year 2 and 3 for the year. Some expenses, as you can see, remain stable over time, like utilities, rent, insurance, and interest. And the calculation of percent of sales for each of the expense items for year 1 can be used as a guide for determining your projected sales and expenses for year 2 and then for year 3. Selling expenses, advertising, salaries and wages, and taxes may be represented as a percentage of projected net sales. And anytime you do a pitch, make sure that you know the percentage, not just the numbers. And here's the pro forma income statement, but this time it includes the percent. Now, let's talk about pro forma cash flow. Cash flow is not the same as profit, because the profit is the result of subtracting expenses from sales. But cash flow is the difference between actual cash receipts and cash payments. Cash flows only when the actual payments are made or received. Cash payments to reduce the principal on a loan are not a business expense, but they do reduce cash. Interest is an expense. Depreciation is an expense, and this reduces profit, but it does not reduce cash. For sales transactions that involve a credit card, for example, up to 3% of the sale is paid as a fee to the credit card company. It is unfortunate, but many firms fail because of lack of cash. There are 2 standard methods for projecting cash flow, the direct and indirect method. In the indirect method, some adjustments are made to the net income based on the fact that actual cash may not have actually been received or disbursed. For example, in some industries, it is normal to give your customers up to 90 days to pay. So therefore, you can't calculate if you sell something, that goes toward your profit, but you can not calculate the cash coming in as soon as you sell something. A simple determination of cash in less cash out gives a fast indication of the cash position at a point in time. If disbursements are greater than receipts, then you will need to borrow or use your cash reserve. The most difficult problem with projecting cash flows is determining the exact monthly receipts and disbursements. So your assumptions should be conservative, so enough funds can be maintained to cover the negative cash months. So in summary, a cash flow statement is a financial statement that tracks the inflow and the outflow of cash in a business over a specific period. It provides a detailed picture of how cash is generated and how it's used in a startup's operations. It consists of 3 main sections: your operating activities. This section includes cash flows related to day-to-day operations of the business. So it covers cash received from customers, your inflows, and cash paid for expenses, your outflows. It helps determine whether the startup's operations generate positive or negative cash flow. Investing activities. In this section, you can record cash flows from buying or selling long-term assets like equipment, real estate, or investments. And your financing activities. In this section, you can document cash flows that are related to obtaining or repaying financing. So in sum, you should be creating and regularly updating a cash flow statement. It helps you with your liquidity management, your financial planning. It'll give confidence to your investors or lenders. And here's a simplified guide to creating a cash flow. Number 1, gather your data, including bank statements, invoices, and so on. Number 2, identify your cash flows. Categorize the cash flows into the 3 main sections I mentioned. Calculate your opening cash balance. So determine the cash balance at the beginning of the period. Then take a look at your operating activities. List all the cash inflows from sales, investments, and other sources. List all the cash outflows, including expenses, salaries, and supplier payments. And then calculate the net cash flow from operating activities. That would be your inflows minus your outflows. You'll have to do something similar with investing and financing activities. For your closing cash balance, you'll calculate the closing cash balance by adding the net cash flows from all 3 sections. And then analyze the cash flow statement to identify trends, cash flow patterns, and any potential issues. And lastly, I'll say remember to regularly update it. Using the pro forma income and cash flow statements, you should prepare your projected balance sheet. Your pro forma balance sheet reflects the position of the business at the end of year 1. It'll summarize the assets, liabilities, and your net worth. It shows how solvent the company is. A ratio analysis of current assets to liabilities indicates how well your company can pay its bills. A ratio of less than 1:1 shows that the company needs more cash in order to meet its current obligations. Every business transaction affects the balance sheet. So, all in all, the balance sheet is a picture of the business at one moment in time. So, it includes assets, we said, and assets represent everything of value that is owned by the business. Value is not necessarily the replacement cost, it's the actual cost expended for the asset. The assets are either current or fixed. Current assets would include cash and anything that will be converted into cash or consumed in the operation within a year. Fixed assets are tangible and will be used over a long period of time. Management of receivables or money that is owed to the new venture from customers is important to the cash flow. Liabilities. Liabilities represent everything that you owe to creditors. Current liabilities represent everything owed to the creditors that are due to them within 1 year. On the other hand, long-term liabilities extend over 1 year. Lastly, owner's equity is the excess of all assets over all liabilities. Owner equity is the net worth of the business. Any profit from the business will also be included in the net worth and will show as retained earnings. And here's an example where you see assets and then current assets, fixed, and then total. On the second part, you have liabilities and owner's equity. Liabilities, owner's equity from each partner, retained earnings from the profits, and liabilities and owner's equity. In the initial stages of a new venture, you should know when a profit may be achieved. So for this, you'll have to perform a break-even analysis. And so What is it? It's a technique that will help you determine how many units you need to sell in order to break even. So break even is that volume of sales at which the business will neither make a profit nor incur a loss. The break-even sales point is the volume of sales needed to cover total variable and fixed expenses. And here's the break-even formula. You have it on your screen. BEQ is the break-even quantity, and that is equal to TFC, that stands for total fixed costs, over selling price minus the variable cost per unit. As long as the selling price is greater than the variable costs per unit, some contribution can be made to cover fixed costs. The major weakness in calculating break-even is determining whether a cost is fixed or is variable. And so that's where your judgment will come in. Fixed costs are usually depreciation, salaries and wages, rent, and insurance. Variable costs are things like materials, selling expenses, and direct labor. When the firm produces more than one product and it is feasible to allocate fixed costs to each product, then it's possible to calculate a break-even point for each product. And so you can adjust some of these variables. For example, you can adjust price to see how that will impact your break-even analysis, your break-even point. The pro forma sources and applications of funds statement illustrates the disposition of earnings from operations and other financing. The objective is to show how net income and financing were used to increase assets and pay off debts. Where do funds come from? Typically from operations, new investments, long-term borrowing, and sales of assets. How are they used? Typically to increase assets, to pay off liabilities, reduce owner equity, and pay dividends. Here's a simplified example. So in essence, a pro forma sources and applications of funds outlines the sources of funds and the applications of funds. In the sources, it identifies how the business expects to secure funds in the future. It includes sources like loans, equity investment, sales revenue, any other financing. In the applications of funds, you see how the business plans to use the acquired funds. It includes expenditures such as operating expenses, marketing campaigns, equipment purchases, and so on. Now, why is it important? Well, it's important for several reasons. Number one, financial planning, because it helps you plan your strategies to make sure that you have the capital you need to support your business. Two, funding needs. It helps you project future funding needs. That way you can proactively seek financing options. Number three, resource allocation, because it assists in allocating resources efficiently by identifying where capital is needed. Number four, investor and lender relations. Entrepreneurs can use this statement to communicate your funding needs and your financial plan to potential investors or lenders. That way you can show that you understand your business's financial requirements. Lastly, like we said with the other statements, review and adjust. So make sure that it's not a document that you create one time and you forget about it. Make sure that you go back, you review and adjust periodically. Now that we have discussed all the financial statements that you need, let's talk about some software packages that can help you track financial data and they can help you generate financial statements. Obviously, the easiest way to generate financial statements for a smaller company might be spreadsheets. For example, using or creating spreadsheets on Excel. The other benefit is that it also gives you some flexibility because then you can create different scenarios. Any software package that you select, if you decide not to do it on Excel, for example, and you would rather have a software package, just make sure that it's very simple and easy to use. Most software packages allow the same functionalities, for example, check writing, payroll, inventory management, and so on. A simple one that is cited in the book is Intuit's QuickBooks, but there are a ton out there. Some of them are internet-based. Other options are FreshBooks, Zoho Books, and like I said, there are a ton out there. And that brings us to the end. So just to summarize, it's important that you understand the role of budgets in preparing pro forma statements, as well as understanding that positive profits are not necessarily the same thing as positive cash flows. We discussed learning how to prepare monthly pro forma cash flow, income, balance sheet, and sources and applications of fund statements. And lastly, we discussed the break-even and some software packages that you can use. And that wraps up chapter 10. If you have any questions, let me know. Otherwise, just head to Blackboard and continue with the activities. Until next time, bye.